Kathryn Rooney Vera, who's the head of research and strategy at Baltic. Kathryn, great to have you here with us today. We've seen quite a few ups and downs recently, and we're set to get to October next week. My God. How are we rounding out the month here?
Well, it's been a very volatile and choppy month, as you both have mentioned. And I'd say that really, I think things are simpler than what a lot of people are making them out to be. I would say that there is one thing that has taken these markets to record highs amidst a recession, and that is both fiscal and monetary stimuli. And I think that the market drops when there's any semblance of disappointment on either front. When we saw, the deceased Ruth Bader Ginsburg, the Supreme Court justice, pass away, the following day the market slid. And I think that had a lot to do with the fact that the fiscal stimulus package, the third thereof, might actually be pushed back and perhaps indefinitely so. Today, markets are up because negotiations are at least being talked about again on the fiscal package. So, look, I think that if you expect fiscal stimulus to happen again, it doesn't have to be in the next 42 days or however long it is till November 3rd. But if you expect it to happen in the short-term horizon, which I do, and if you expect the Fed to stay on board with its asset purchase program, then I think you're buying these markets, Brad.
Interesting. Okay, so as we talk more about stimulus, what particularly in terms of a marker, because we've heard a few different dollar figures that have been tossed out there, and this is an extremely, the most moving target perhaps that we've ever talked about in the history of moving targets. Not to be, eccentric around it or extravagant around it, but just to say the gravity of this particular situation and trying to get the number right so that Americans and businesses have the funding and the aid that they need to get through this pandemic till the point when the economy fully reopens or at least starts to get back to showing that it's found foundation over time. That number is a moving target here. And so what particularly are you going to be looking at within these negotiations and the details of where parts of the economy are going to be sustained?
There is no magic number, and I'm firmly convinced of that. I think that when you look at the numbers and you see that for the month of April, when we first got, Brad, that first round of stimulus checks sent to people's households that qualified for them, you saw that the percentage of personal incomes that were attached to government benefits skyrocketed to 30%. So I don't think that we can discard the reality that the rebound in consumption that we've seen over, the recent, let's call it 4 months, right, is due to stimuli. It's due to enhanced unemployment benefits. It's due to direct transfer payments to households. So we have, $11 trillion already in the system. I think the question is really, how much do we actually need? Or can we get through with a simple extension of the top off on the unemployment benefits? I think we have to be careful, honestly, with how much we indebt ourselves at this juncture. Just to put things, if I may, in a frame of reference, with Lehman Brothers, and I was at Bear Stearns when it collapsed, with the Lehman Brothers Bear Stearns financial crisis of 2008 to 2010, remember our stimulus package totaled $1.9 trillion, and that was the TARP. Right now, we're at $11 trillion and counting. And this has been really, and the magnitude of the fiscal reaction, I think we must consider. So the thing that calls my attention here is not whether or not we should do another round of fiscal stimuli, but the magnitude of the package, right, Brad? I mean, you're asking me what's the magic number, but we're not even talking about whether or not it should happen or whether or not we should see how the $11 trillion that's already been injected into the system plays out, or how inflationary this might be down the line. But yeah, I think it's going to be between $1.5, $3 trillion, depending on who wins the election. Certainly the Democrats are favoring above $3 trillion. The Republicans want, half that. But something is in the pipeline, and I think the markets will rally as a result.
And as you think about some of the equity markets movement that we've seen during the month of September, we do know that the last 10 days of September typically have this history of being some of the worst trading days, or at least over a period of time during the year. So what are you expecting, at least then, going into this final calendar year quarter? And do you expect that investors will try to find some rotation opportunities where they can?
I like the barbell strategy, which is accumulation of risk assets when the market opens up opportunities. I like that combined with the inflation hawk side of me, which says we need to be buying tips. Hey, the Fed's buying them. We should probably be buying what the Fed is buying, and then be one step ahead of what the Fed is more likely than not going to be purchasing in the future, which in my view is high yield bonds. The Fed is buying right now one high yield bond, and that's Ford Motor Company. So I suspect that if we get a downslide pertaining to the elections or pertaining to anything, Brad, really, if we get a 20% correction in the S&P, I think the Fed steps in and increases its balance sheet, and my bet is that it does so in the high yield horizon. So that's why I'm recommending actively to our investors fallen angel bonds, which are those bonds that have recently lost their investment grade rating. So risk assets, and I think we're going to get, Brad, a lot of opportunities in the forthcoming 3 months to add exposure to risk assets, counterbalanced with the purchase of gold, tips, treasuries, lower correlated asset classes such as private equity, and some increase in people's weightings to cash is never a bad idea.
Internationally, as you look across the other countries and how we've conducted business, but how those other economies have done post reopening, and some of them now needing to reclose, we're going to see a starkly different reaction perhaps if we continue to see rising cases as we're seeing in 23 states right now, and we are, or at least have been told that we are not going to reclose the economy, especially going into the election. That has political implications, but that also has economic implications as well. You have airlines that are also waiting for reopenings as well, and funding. And for the airlines, as I think about them, is that another area that you expect the Fed to announce further steps in some of their own bond buying?
That's a great question. And let's face it, Delta is one of the fallen angels, right? So are the airlines ever going to be allowed to, given that there's three of them, right? Is any of the three majors going to be allowed to, go the way of the dodo bird? I doubt it. So it's also a national security risk if you let one of the three go away, and not to mention monopoly issues. But look, I think that the death rate is definitely far lower in this resumption of cases that we've seen in some states. In my state of Florida, for example, today Governor DeSantis just reopened us completely, so the restaurants are now able to do business. So let's see how that goes. But the fact, Brad, it is, and I said this when we closed back in, what was it, March, April, is that there's undesired consequences also of closing down the economy, and that comes with health reasons and massive unemployment, structural unemployment, mental health. So yeah, I think we cannot take it lightly going into a second bout perhaps in the winter and considering economic closure. I would probably be more against that than for that. Let's see how it goes. In Europe, they're experiencing this now, but hopefully we get past this and we have a vaccine on the near-term horizon.
Yes, we didn't even get into talking about the vaccines. Of course, we need to have you back very soon. Kathryn Rooney Vera, Head of Research and Strategy at Baltic. Thanks.